I usually assume that the businesses I interact with are either still run by the people that started them or owned by regular shareholders through the stock market. But a lot of the businesses around us, such as restaurants, manufacturers, healthcare providers, are actually owned by private equity firms that most people never even hear about. These firms own more of everyday life than people realize. From car washes to vet clinics, to the apartment complex you might live in. Um, I think understanding how the industry actually works explains a lot about how the business around us get run. So today, I want to walk through three things. What private equity actually is, how the returns it generates comes from real value creation instead of financial risks and tricks, and why institutional investors keep putting billions of dollars into it every year. A little bit about myself. I work as a mergers and acquisitions summer analyst at a boutique sell-side advisory firm, so I get to see firsthand how private equity buyers approach deals in the lower middle market. I'm also working towards a real estate analysis and development certificate, and I help manage rental properties with my family. So I've gotten some hands-on exposure to how investors think about holding on to assets over time. For this speech, I read through five peer-reviewed academic sources on private equity structure, returns, and institutional allocation. Here's where I'm headed. First, I'll get into what private equity actually is and how the fund structure works. Second, I'll explain how private equity returns actually get generated. And third, I'll talk about why institutional investors keep committing money to the asset class. Let's start with what private equity actually is. I think the easiest way to understand it is through the fund structure that connects investors to these buyout deals. Kaplan and Schoenberg in a 2009 paper explained that in a leveraged buyout, a specialized investment firm buys a company using a relatively small amount of equity and a much bigger chunk of debt, usually somewhere between 60 and 90% of the deal. These firms raise their capital as general partners, and the money comes from limited partners like pension funds, insurance companies, endowments, who all commit their capital to a fund for a set number of years. Kaplan and Schoenberg also point out that the biggest investors in private equity tend to be public pension funds. Because of this structure, private equity firms are paid through management fees and a share of profits, which gives them a direct incentive to improve the companies they buy rather than just flip them. Once you understand how the private equity fund is put together, the natural next question is where the funds um, usually come from. From what I've found, private equity returns come mostly from real operational improvement, not from financial engineering or any short-term tactics. Hartford and Kalansky in a 2014 study set out to set whether the high return private equity sponsors are known for actually coming from wealth transfers away from other parties, such as lenders or the companies these firms buy from. What they found was when public companies buy portfolio companies from private equity firms, those public buyers actually come out ahead on average. They also found that private equity-backed companies don't invest any differently than similar public companies, which pushes back pretty hard on the idea that these returns come from short-termism. Diller and Kanzer in a 2009 study dug into what actually drives the return private equity funds generate. They looked at how much capital is flowing into the industry, how skilled the general partners running the funds are, and how much risk investors are taking on. Their research backs up the idea that when a lot of capital flows into private equity at once, something researchers call money chasing deals, it tends to compress the returns available. To me, that says general partner skill and disciplined deal selection matter a lot more than luck. Since private equity returns seem to come from actual value creation rather than financial tricks, it makes sense that big institutional investors keep coming back to the asset class. Staying vested is more complicated than it sounds, though. Institutions keep allocating to private equity for two main reasons. Certain investor types genuinely perform well in it, and there are real strategies for managing how illiquid these investments are. Lerner, Schiller, and Wang Sui in a 2007 study looked at the returns different types of institutional investors earned from private equity and found some pretty dramatic differences across investor classes. They found that university endowments earned annual returns nearly 21% higher than those of the average investor, and that endowments were better than other investor types at identifying which follow-on funds would actually perform well. Now, since private equity commitments are liquid and the cash flows are hard to predict, institutions need some strategy to keep their portfolios near the target allocation over time. Deswort, Fraser, and Van Dijk in a 2012 study developed a dynamic recommitment strategy that adjusts the amount of new capital in an institution commits each year based on distributions. And it has received and the amount of capital still uncalled from earlier commitments. Using historical data going back through 1980 through 2005, they found that the strategy kept the portfolio's private equity investment level close to its target, about 86% of target on average, while keeping the odds of being overinvested down to just 8%. So let's bring this all back together. I walked through what private equity is and how the fund structure connects to investors to buy out deals. I walked through how private equity returns are generated through real value creation rather than wealth transfers or short-termism. And I walked through why institutions keep allocating to private equity, both because of how well certain investor types perform and because of the strategies available for managing how a liquid asset class is. Private equity really comes down to three things: a fund structure built around raising capital and using leverage to acquire companies, returns that come from real operational value instead of financial tricks, and institutions that keep allocating to it because the numbers and the tools available to manage it actually support doing so. So the next time you hear that a company got acquired by a private equity firm, I hope that you have a better sense of what's actually going on behind that headline and why so much institutional money keeps flowing into deals like it.